Question 10. What are the key risks associated with the ARKK ETF's investment strategy? The ARKK ETF's investment strategy, while aiming for high growth, comes with inherent risks. Here's a breakdown of the key risks to consider. Focus on disruptive innovation. Uncertainty around new technologies. Disruptive innovation, by its nature, involves new and unproven technologies. There's a chance that these technologies might not succeed or take much longer than anticipated to gain widespread adoption. This uncertainty can lead to significant losses for ARKK's holdings. Rapid change. The field of disruptive innovation is constantly evolving. Companies that are leaders today might be disrupted by even newer technologies tomorrow. ARKK needs to continuously adapt its holdings to stay ahead of the curve, which can be challenging. Concentration and lack of diversification. Exposure to a limited set of sectors. ARKK primarily invests in technology-driven sectors. If these sectors experience a downturn, it can disproportionately impact the ETF's value compared to a more diversified portfolio. Concentration risk. ARKK tends to hold a smaller number of companies compared to some broad market ETFs. This concentration amplifies both the potential gains and losses associated with each individual holding. Growth stock risks. Vulnerability to market downturns. Growth stocks, a core holding for ARKK, tend to be more volatile and experience sharper declines during bear markets compared to value stocks. This volatility can be amplified due to the factors mentioned above. Valuation concerns. Companies positioned for disruptive innovation are often valued based on their future potential growth. If this growth doesn't materialize, their stock prices can experience significant corrections. Other considerations. Management risk. ARKK's performance relies heavily on the expertise and decision-making of the ARK Invest team. If their analysis of disruptive innovation trends proves to be inaccurate, it can negatively impact the ETF's returns. Currency fluctuations. Since ARKK invests internationally, its value can be affected by fluctuations in foreign exchange rates. Mitigating risk. Long-term investment horizon. Given the inherent risks, ARKK is generally suitable for investors with a long-term investment horizon who can stomach potential volatility. Part of a diversified portfolio, including ARKK as a part of a well-diversified portfolio with other asset classes, can help mitigate some of the risks associated with its concentrated holdings. Question 11. Does ARKK ETF contribute to portfolio diversification? ARKK ETF's contribution to portfolio diversification depends on your existing holdings and your overall investment strategy. Here's a breakdown of the factors to consider. Limited diversification within ARKK. Concentration in technology sectors. ARKK primarily invests in technology and technology-enabled sectors. While these sectors offer high growth potential, they also move together to a large extent. A downturn in tech can significantly impact the entire ETF. Fewer holdings. Compared to broad market ETFs that hold hundreds or even thousands of companies, ARKK focuses on a smaller number of holdings. This concentration magnifies both the potential gains and losses associated with each individual company. Potential benefits for diversification. Different asset class. Since ARKK is an equity ETF, it provides exposure to a different asset class compared to bonds or cash equivalents. This can help diversify your portfolio across asset classes with potentially different risk-return profiles. Alternative to traditional growth stocks. If your portfolio lacks exposure to growth stocks entirely, ARKK can offer a way to gain access to this asset class, albeit with a concentration on disruptive innovation. Maximizing diversification with ARKK. Combined with broad market ETFs, to truly benefit from diversification, consider pairing ARKK with a broad market ETF that tracks a wider index, like the SP 500. This can help reduce your portfolio's overall concentration in technology sectors. Don't overweight ARKK. While ARKK might offer growth potential, limit its allocation within your portfolio to manage the risks associated with its concentrated holdings and focus on disruptive innovation. Question 12. Are there other ETFs with similar objectives of ARKK ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to ARKK, but lower expense ratios. Here's a breakdown of some alternatives to consider. Focus on disruptive innovation. SPDR-SP Kensho New Economies Composite ETF. KOMP. This ETF uses artificial intelligence and natural language processing to identify companies at the forefront of technological advancements and themes like robotics, automation, and artificial intelligence. Its expense ratio is significantly lower than ARKK's at 0.20%. Global X Disruptive Innovation ETF, DISS. This ETF focuses on companies across the globe that are driving disruption in various sectors, including healthcare, financials, and consumer staples. It has an expense ratio of 0.68%, lower than ARKK, but higher than KOMP. Broader technology exposure. Vanguard Information Technology ETF, VGT. This ETF tracks a broad index of technology companies, offering exposure to established giants and innovative players alike. While not as focused on pure disruption as ARKK, it provides a more diversified approach within the technology sector. Its expense ratio is a very low 0.3%. SPDR SP Software Services ETF, XSW. This ETF focuses specifically on software and service companies, a large and growing segment within the technology sector. It offers a more balanced approach compared to ARKK and has a lower expense ratio of 0.9%. Choosing the right alternative. Expense ratio. Consider the expense ratio as a key factor. A lower expense ratio translates to a larger portion of your investment return staying with you. Investment focus. While all these ETFs share some overlap with ARKK's objective of capturing growth, they differ in their specific focus areas and diversification levels. Choose one that aligns with your desired level of concentration on disruptive innovation and technology exposure. Risk tolerance. Remember, these ETFs, despite potentially lower expense ratios, still carry inherent risks associated with technology and growth stocks. Question 13. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, building a portfolio with a combination of individual stocks or other ETFs could potentially achieve a similar outcome to ARKK, with potentially lower costs and greater control. Here's a breakdown of the pros and cons to consider. Potential benefits. Lower costs. By selecting individual stocks or ETFs with lower expense ratios than ARKK, you can potentially keep more of your returns. Greater control. You have the flexibility to choose specific companies or ETFs that align with your investment thesis on disruptive innovation or technology sectors. This allows for a more tailored approach compared to ARKK's pre-selected holdings. Tax efficiency. You can potentially manage capital gains taxes more strategically by controlling when to sell individual holdings within your portfolio. Challenges and considerations. Research and analysis. Selecting individual stocks requires in-depth research and analysis of each company. This can be time-consuming and requires a strong understanding of financial statements and company fundamentals. Diversification. Building a diversified portfolio with individual stocks can be challenging. You'll need to hold a sufficient number of companies across different sectors and risk profiles to mitigate risk. Trading costs. Frequent buying and selling of individual stocks can incur trading commissions, which can eat into your returns. Active management. Managing a portfolio of individual stocks or multiple ETFs requires ongoing monitoring and rebalancing, which can be time-consuming. Alternative ETF combinations. Here's an example of how you might combine ETFs to achieve a similar outcome to ARKK. Core Technology ETF. An ETF like Vanguard Information Technology ETF, VGT, provides broad exposure to the technology sector. Disruptive Innovation ETF. An ETF like SPDR SP Kensho New Economies Composite ETF, KOMP, offers a more focused strategy on disruptive innovation. International Technology ETF. An ETF focused on international technology companies can add further diversification. Question 14. What are the pros and cons of this ARKK ETF compared to similar options? Here's a breakdown of the pros and cons of ARKK ETF compared to similar options that target disruptive innovation or technology exposure. ARKK ETF. Pros. High growth potential. ARKK focuses on companies at the forefront of disruptive innovation, which can lead to significant growth if these companies succeed. Actively managed. The fund managers have the flexibility to adjust holdings based on their ongoing research and analysis of disruptive innovation trends. Global reach. ARKK invests in innovative companies worldwide, offering broader exposure than some competitors. Cons. Higher expense ratio. ARKK's expense ratio, 0.75%, is higher than some similar ETFs. Less diversified, ARKK concentrates on a smaller number of holdings within technology-related sectors, leading to less diversification compared to some alternatives. Higher volatility. The focus on disruptive innovation and growth stocks can lead to more significant price fluctuations compared to broader market ETFs. Management risk. ARKK's performance relies heavily on the expertise of the ARK Invest team in identifying and selecting winning companies within disruptive innovation. Similar ETFs. Pros. Lower expense ratios. Several alternative ETFs offer similar exposure to disruptive innovation or technology sectors with lower expense ratios. More diversification. Some alternatives provide broader diversification within the technology sector or even across different sectors, potentially reducing risk. Lower management risk. These ETFs might track a specific index, reducing reliance on the decision-making of a single investment team. Cons. Potentially lower growth potential. While offering diversification, some alternatives might have lower growth potential compared to ARKK's focus on disruptive innovation. Less flexibility. Index-based ETFs might have less flexibility to adapt to changing trends compared to actively managed ARKK. Limited global reach. Some alternative ETFs might focus on specific regions, potentially missing out on global innovation opportunities. Choosing between ARKK and similar options. The best choice for you depends on your investment goals and risk tolerance. For high growth potential with higher risk, if you prioritize high potential returns and are comfortable with significant volatility, ARKK might be an option. For lower costs and more diversification, if you prefer lower fees and a more diversified approach within technology or disruptive innovation, consider alternative ETFs with lower expense ratios. For a balance, you could even combine ARKK with a broader technology ETF or an index-based innovation ETF to achieve a balance between growth potential, diversification, and cost. Question 15. What are the potential benefits and drawbacks of investing in ARKK ETF compared to individual stocks within the same sector? Here's a breakdown of the potential benefits and drawbacks of investing in ARKK ETF compared to individual stocks within the same disruptive innovation or technology sector. ARKK ETF. Benefits. Diversification. Although ARKK concentrates on technology-related sectors, it holds a basket of companies, offering some level of diversification compared to owning just a few individual stocks. Professional management. A team of experts at ARK Invest manages ARKK, actively researching and selecting companies they believe are positioned for disruptive innovation. Lower transaction costs. Purchasing shares of ARKK typically involves a lower transaction cost compared to buying multiple individual stocks. Liquidity. ARKK is a relatively liquid ETF, meaning you can easily buy and sell shares on an exchange. Drawbacks. Limited control. You don't have direct control over the specific companies held within ARKK. You rely on the decisions made by the ARK Invest team. Higher expense ratio. ARKK's expense ratio, 0.75%, eats into your returns compared to buying stocks directly, although some brokerages charge commission fees for stock purchases. Average performance of holdings. Even if ARKK identifies some high-growth companies, the overall performance might be dampened by holdings that underperform. Individual stocks. Benefits. Greater control. You can choose the specific companies you want to invest in, allowing you to tailor your portfolio to your investment thesis on disruptive innovation. Potentially lower costs. Individual stocks might have lower overall costs if your brokerage charges a commission fee per trade but offers commission-free ETF trades. Potentially higher returns. If you successfully pick winning stocks within the disruptive innovation or technology sector, your returns could be higher than ARKK's overall performance. Drawbacks. Higher risk. Investing in individual stocks carries a higher risk compared to a diversified ETF. The performance of your portfolio hinges on the success of those specific companies. Research and analysis. You'll need to conduct thorough research and analysis to identify promising individual stocks within the disruptive innovation or technology sector. Time commitment. Actively managing a portfolio of individual stocks requires ongoing monitoring and potentially frequent rebalancing. Lower liquidity. some individual stocks, particularly those of smaller companies, might have lower liquidity, making it difficult to buy or sell them quickly. Choosing between ARKK and individual stocks. The best choice depends on your investment goals, risk tolerance, and resources. For convenience and diversification, if you prioritize convenience, some level of diversification, and professional management, ARKK might be a good option. For control and potentially higher returns, if you're comfortable with in-depth research, enjoy picking individual stocks, and have a higher risk tolerance, then investing in individual stocks could offer potentially higher returns. For a hybrid approach, you could even combine ARKK with a few strategically chosen individual stocks to leverage the benefits of both approaches. Question 16. Would adding ARKK ETF improve the portfolio's diversification or potentially increase concentration risk? Adding ARKK ETF to your portfolio could increase diversification or concentration risk, depending on your existing holdings. Here's a breakdown of the scenarios. Increased diversification. Limited overlap with existing holdings. If your portfolio currently lacks exposure to technology and disruptive innovation sectors, adding ARKK can introduce a new asset class and potentially improve diversification. This is because ARKK holds a basket of companies within these sectors, offering some level of diversification within itself. Complements broad market ETFs. If you already hold a broad market ETF that tracks a diversified index, adding ARKK can further enhance diversification by providing exposure to a more specific growth-oriented theme. Increased concentration risk. Existing technology holdings. If your portfolio already has a significant weighting in technology stocks or ETFs focused on technology sectors, adding ARKK might increase your overall concentration risk. Both ARKK and your existing holdings might be vulnerable to similar downturns in the technology sector. Limited diversification within ARKK. While ARKK holds multiple companies, it focuses on technology-related sectors. Adding it to a portfolio already concentrated in a different sector might not significantly improve diversification. Here's how to assess the impact on your portfolio. Analyze your existing holdings. Identify the sectors and asset classes your portfolio currently comprises. Consider the overlap with ARKK. See how much overlap exists between your current holdings and the sectors ARKK focuses on. Evaluate your risk tolerance. If you're comfortable with increased exposure to technology and potential sector-specific volatility, ARKK might be suitable. Strategies to mitigate concentration risk. Limit ARKK's allocation. If you choose to add ARKK, keep its allocation within your portfolio at a moderate level to limit its impact on overall diversification. Pair with broad market ETFs. Combine ARKK with a broad market ETF that tracks a wider index to ensure diversification across various sectors and asset classes. Question 17. Does ARKK ETF offer a unique exposure that wouldn't be easily replicated through other holdings? ARKK ETF offers some unique exposure, but it depends on the specific holdings within your existing portfolio. Here's a breakdown of the unique aspects of ARKK and how they might complement other holdings. Unique aspects of ARKK. Active management with focus on disruptive innovation. ARKK's actively managed approach allows the fund managers to select companies they believe are at the forefront of disruptive innovation themes. This focus might not be easily replicated through passively managed ETFs that track a broad index. Global reach. ARKK invests in innovative companies around the world. While some international ETFs exist, ARKK's specific holdings and the ARK Invest team's analysis might provide unique exposure compared to a passively managed international technology ETF. Potential replication through other holdings. Broad technology ETFs. Several ETFs offer broad exposure to the technology sector. While they might not capture the same level of focus on disruptive innovation as ARKK, they can provide a good starting point. Thematic ETFs. There are ETFs targeting specific themes within technology, like artificial intelligence or robotics. These can offer a more focused approach similar to ARKK, but might not have the same global reach or active management component. Individual stocks. By carefully researching and selecting individual stocks within disruptive innovation sectors, you can potentially achieve a similar level of focused exposure as ARKK. However, this requires significant research, analysis, and carries a higher risk of underperformance compared to a diversified ETF. Overall, ARKK offers a unique combination of Active management focused on disruptive innovation. Global reach within technology and technology-enabled sectors. Alright, Chat ETF fam, that's all the time we have for ARKK today. So, the big question, is ARKK right for you? It depends. If you're looking for high growth potential and can stomach some volatility, ARKK could be a good fit, especially as part of a well-diversified portfolio. However, if you prioritize lower costs or a more balanced approach, alternative ETFs or even individual stock picking might be a better option. Remember, do your own research before investing in anything, including ARKK. Hit that like button if you learned something new about ARKK today, and let us know in the comments below what other hot ETFs you'd like us to chat about. We'll be back soon with more in-depth ETF breakdowns to help you navigate the exciting world of investment. Until then, keep chatting ETFs.